Hey everybody, this is Dan Gandee, owner of the Operative Group here in Oregon, and this is how my investment company and our real estate brokerage team runs through investment properties to value them very quickly in terms of making sure that we know what to write as an offer, what we see as value add potential, and or if we're listing a property or selling one of our own investment properties from our portfolio, how we can package it up and make sure that we're providing good due diligence and so that investors can look very quickly at what we ran in actual numbers versus pro forma numbers. And so let me break this down really quickly. Our property details is where we start. This is step number one. We're going to make sure that we start with the asking price. This green cell is going to be either what you're going to offer on the property or what it's listed for or what you think the value of the property is actually worth. And so typically what we're putting in here is what is listed for if we're looking at on-market properties, or if a seller comes to us and says they want this much money, we're going to look at what it means in terms of valuation with their numbers. Next, we're going to start with the B column, which is the actuals for the month, okay? And so first unit, we have $1,791 rent. Second unit, we have $791 rent. So both units are the exact same rent, which is giving us a GOI, a gross operating income of $3,582. Now, line 13, don't get confused here. This could be laundry income. This could be pent rent. This could be parking income. This could be a billboard on the property. Whatever it is, monthly, what are you getting for any additional income? Next, and the biggest question that we always ask, what utilities is the landlord paying for? Because if they're not paying for it, then that means that somebody else is, and that's all we care about. For this specific property, $266.66 a month was going towards water and sewer, and then $123 was going towards trash. Now, if water and sewer need to be separated out, you just create another cell and have it completely accounted for properly. But what we see is that the landlord is paying $389.66 a month in utilities that are being subtracted from this gross operating income. Next, we take the property taxes for the annual amount divided by 12, gives us $625 a month. That's annual tax amount divided by 12 months equals that amount. Then any other expenses that could be provided to us. Let's just say that there could be a wealth of things that I'm not going to go into, but you could take a complete P&L and take all of the other expenses that are not utilities, taxes, and insurance and plug that number in to make this very accurate, okay? Then we take the annual insurance policy, we divide it by 12, it gives us $104.91 a month is what they pay for property insurance. And then what it does is it provides us a gross operating expense total, which essentially is going to add up these numbers and then add up these numbers to give us this number, which then is going to be subtracted by the gross operating income, which is the monthly income coming in from the rents, to give us a net operating income of $2,462.43, okay? So that gives us a monthly snapshot of what's going on right now. You don't change those numbers. Those numbers are what you're getting in terms of coming from your client, or when you call an investment listing agent and you say, hey, what is your property doing for X, Y, and Z? All right. And guys, word of the wise, if somebody can't give you information prior to writing an offer and they don't know this numbers, they shouldn't even be selling investment properties to begin with. And I say that very bluntly because it's so true. So many agents out there do not know how to package up investment properties and sell them properly. So this column should be easy to fill out within a simple phone call, right? Or that information should be on the MLS so that you can be able to get this information quickly. All right. Next, what it's going to do is it's going to go to column D and make actuals for the year. What it's doing is taking your monthly amount, multiplying it by 12, right? And there might be some variance in here as things change. You know, certain expenses happen at different times. We're not going to go into rabbit holes again and look at things that might be changing month to month. But what we're looking at is what ballpark in terms of actuals a year are we making on that property? And what we're seeing is that $42,984 in total rents and $29,549.16 is actually coming in as net operating income, which then is taxable, okay? So what I'm getting at is that we can see 29,000 basically divided by almost 43,000 is going to give us some ballpark expense ratio of what income is left after expenses, all right? And then what we're doing is trying to figure out some cap rate based upon this price that has been plugged into the property details. And what we see is that this cap rate is 4.22%. All you got to do is contact a commercial broker, do some simple 5 minutes of Google research, and you can figure out what the cap rate is between 1 and 4 units or 2 and 4 units in that specific area, and how does that compare, right? Next, what we're seeing is the gross rent multiplier is 16.28. Well, in Oregon, 10 to 12 gross rent multiplier basically is pretty good. Anything under 10, there's either red flags or you just got a crazy amazing deal. Anything between 13 and about 17 is middle of the road. Anything above 18 to 20 plus is probably new construction, high acquisition cost. Rents aren't making that break-even point make sense unless you hold on to the property for long-term or play appreciation. But really what I'm trying to get is you're trying to get a quick snapshot of what is the cap rate and what is the gross rent multiplier and how does it compare to the market or other properties that are sold as comps. And then what we do is then we look at value add. And what value add is going to be is going back to column C, which is going to give us pro forma. Pro forma basically means what could we do to this property to make it perform better. And so what we see here is if we did a double eviction, removed both tenants and moved the rents to $2,250, which is market rent in that neighborhood, we would go from $3,582 to $4,500, almost $1,000 more in gross operating income per month. Then let's just say that we said, hey, all utilities are on the tenant. This is all hypothetical, but then we've decreased the monthly gross utilities expense down to $0. Okay. Property taxes are going to stay the same or be increased at acquisition, and then insurance stays the same. Okay. So your gross operating expenses went from $1,119.57 down to $729.91, which essentially is giving you a new net operating income of $3,770 versus $2,462.43, a significant value add. Okay. And then just so you guys know that it would provide a new valuation of that property with that increase in rents, but we're not going to be looking at that. We're just saying that if we stayed at this same price point, okay, this asking price, but you could get the rents to this, what would it mean in terms of performance on a yearly level? Well, you could take that 4.22% and move it to a 6.46% cap rate, right? Nearly more than 2% increase in cap rate. And so just by that valuation of that property, doing some pro forma, doing some repositioning, doing some value add, decreasing expenses, increasing income, we've been able to take it from a 4.22 to 6.46. All right. Now, that's not the actual valuation of the property because the valuation of the property would shift here. But if you're keeping that asking price the same, meaning that you paid that in cash, this is what would happen if you change the rents. Next, what you see is that gross rent multiplier goes down to 12.96. Now we're in that good range, right? So it's giving us a snapshot that if we're buying the property, this is what we need to do. It's giving us a snapshot. If we're selling the property, this is what you could do, potential buyer. All right. Now, not to overcomplicate things, is now that I have monthly actuals, yearly actuals, I have monthly pro forma and annual pro forma. Now I want to show you guys what happens when you add expenses as an asset manager. Now, owning an investment property, even if you're self-managing it yourself, is going to have other expenses, but it's also going to have expenses that you should be allocating each month from the gross operating income in order to protect yourself for a rainy day fund in terms of a roof need, vacancy, marketing, QuickBooks, taxes that you have to, tax preparation that you have to pay, city registration fees, administration, like paying somebody to do something, right? All of these expenses need to be allocated and set aside if you're doing proper asset management. And so what we do is we come up with these percentages. You'll see this on Bigger Pockets calculator, but what I'm typically doing is I'm looking at everything from vacancy to capital expenditures to maintenance and repairs to management. As you can see, property management, I have it 8.5%, which is kind of middle of the road. Some property managers are 10%, some property managers are 6%, depending on what service you're getting. Marketing is 1% of the monthly income coming in. So all of these numbers can be changed based upon the property and what you think you need to do for it. But then it's going to take the expense ratios up here, 17.45, 2.93, 20.38%. And it's going to be able to add all of these together so that once you acquire that asset and you add additional expenses to it, or proper asset management, what is it really operating at in terms of cap rate? Not get gross rent multiplier, just purely cap rate, okay? And so I want to show you something here that's kind of going to blow your mind. Let's just say we use all of these numbers, all right? But let's just say you're going to self-manage. So we're going to move the 8.5% down to, let's just say 4%, because that's what you're paying yourself to manage the property, all right? Give me 1 second. What we can see here now is that at pro forma, you're at a 3.67% cap rate after everything. This does not include debt service or mortgage. That is not included in the valuation of the property. So what I want to really show you is that we have a pretty low cap rate, even with doing value add and removing all of the utility expenses. Once we add in asset management and the expenses that we're most likely need to be allocated for, we're at 3.67% cap rate, which is on the low end in that market. And that's with self-managing it. If you move this back to 8.5%, we're at a 3.32%. So I really want to show you that even at pro forma, we're at a very low end of the cap rate, which is not very sexy, okay? Then I want to show you what it's actually operating at, 0.8, which is not even 1% cap rate. So its current rents at its current acquisition cost with its expenses, with asset management put into place, it's not a good investment. It doesn't cash flow, doesn't follow what we think should be a good value add play in terms of monthly cash flow. But it could be an appreciation play for long-term hold, meaning you're making your money on appreciation or using it to leverage and make more income velocity. But what I want to show you here is that at its current acquisition cost, it doesn't make sense in its actuals. Now, let me show you something. If you moved it, if you didn't offer $699,000, let's just say you could get this property for $550,000. Now the cap rate is 1% in its actuals, and now the cap rate is 4.23% at its pro forma. All right. Let's just say you got super lucky, you found an off-market deal, and you could get this duplex for $500,000 cash on the dot. Now we're at a 4.65 cap rate and a 1.12 actual annual cap rate, and then now at pro forma you could get it to a 4.65. Okay, now we're talking. Now we're within the range of the cap rate in the market. So I want to show you that you have to be looking at expense ratios, because looking at actuals and then adding expenses to them, sometimes you'll look at your property and it won't even be cash flowing. So why are you buying? If you're not owner occupying it, why are you buying it? And that's why a lot of people on the West Coast don't invest here. They invest in other states because they have low acquisition costs but a high rent ratio. Well, here on the West Coast, you need to be playing appreciation, because sometimes we'll see 2x, 3x appreciation. So if you buy a property for $1 million and 20 years later it's worth $3 million, it made you way more money, but you had to put way more chips on the table to play ball. So what I'm really showing you in this video is that the valuation of a property and how you can allocate or change the expenses, how you can remove tenant costs, expenses, how you can raise rents, is how you reposition properties. But you need to have a clear snapshot of where it currently is and a clear snapshot of where you're going to be taking it. And sometimes even where you're taking it, it doesn't make sense in terms of cap rate. Okay. And I want to be very clear here that all of this is based upon acquisition cost and what you can do with the property, right? You make money on real estate when you purchase property. And so I want to make sure that you understand that you got to know what you're going to do. And all of this is going to be showing your cash flow per door. Currently, on a monthly level is only $116, but your cash flow per door on a annual level, on a pro forma level, is you went from $116.32 a month to $484.42 a month in a cap rate at 4.65% once you get rents raised, once you decrease expenses, and you can make sure that you're writing good offers at an acquisition cost that makes sense. All right. So this is the quick way of we break down an annual property operating data report. Yes, there's definitely more expenses and things that you could add to this. But this does not look at cash on cash return. This does not look at debt service and how that impacts things in terms of your monthly payment. If you're only cashing $116.32 and you add mortgage interest onto this that's higher than the cap rate, you're not going to be making money, and it's going to be a losing property. And a lot of people don't understand the dynamics of this. And so thank you so much. If you have any questions, please reach out to me. I can share you the spreadsheet. My email is dan@theoperativegroup.com. You can reach me via text or call at 458-209-0163. Thanks so much.